Inflation rose just 0.2% in June, less than expected, as consumers get a break from price increases, and also, this means that the Fed could be close, if not finished, to raising rates any further from here. So with the potential pause in interest rates coming, the real estate sector, in my opinion, could bottom as soon as cash becomes very cheap to borrow once again. Now in this video, we are going to analyze one of my favorite real estate investment trusts, or REITs, and see why I think it could be a massive buying opportunity as of now, and why I've been buying shares like crazy before the Fed pauses and soon after starts lowering rates again. Now we're going to go through all this and more in this video. Right up to you, please drop a like on it and subscribe for more content like this in the future. So the REIT that we're talking about is NNN, or National Retail Properties. National Retail's roots trace back to 1984 when the restaurant chain Golden Corral formed a REIT to acquire its properties and lease them back. The REIT was advised by National Retail predecessors and provided an investment vehicle for Golden Corral's employees. In the decades that followed, National Retail stayed true to the sale-leaseback model, in which it buys a property from an existing tenant and then rents the property back to the former under long-term triple-net leases, which are very favorable leases for commercial investors. This arrangement requires tenants to pay for insurance, maintenance, utilities, and property taxes. National Retail thus serves purely as a landlord, collecting a recurring stream of high-margin rent, further increasing the predictability of the business model. National Retail maintains a well-diversified portfolio, and the REIT owns over 3,500 properties, which we're going to go through here in a second. So looking a little bit deeper into this REIT's holdings, they have some very familiar top tenants across the country. Companies like 7-Eleven, Mr. Car Wash, Camping World, LA Fitness, Dave & Buster's, AMC, and others. Now, National Retail has a 99.4% occupancy, almost 3,500 properties, 30 plus tenants, 49 states, and 35.3 million square feet of property. Now, to look a little bit deeper into this stock and how it's performed as far as this year so far, it's down around 6.23% after recovering quite a bit over the last few weeks. Now, if we were to look at VNQ, which is the Vanguard Real Estate Index Fund, this paints sort of a bigger picture as far as all the real estate investment trusts across the entire market, because VNQ does hold a lot of them. Now, over the last year, VNQ is down around 4.76%, which isn't necessarily even all that bad. But the reason being that most of the real estate investment trusts have been having some issues, have been underperforming a bit, is because of the cost to borrow money right now has become more and more expensive as the Federal Reserve continues to raise rates. But with the last CPI coming in a little bit lower than expected, I think it's very possible that the Fed either pauses during the next meeting or does one more raise and then pauses, and then after that likely will start lowering rates from there. Now, if this were to happen the way that I think it's going to happen, I think the real estate sector and all the REITs are going to perform pretty well over the next 12 to 24 months. And when it comes to National Retail, the starting dividend yield as of right now, because the way the stock has been beat up over the past year or so, is offering a starting yield of around 5.24%, which honestly, anytime you can lock in a dividend yield over 5%, in my opinion, with it being a very safe dividend yield, that in my book is always a winner. Now, one thing to mention about National Retail is that the dividend growth is not all that fast at a 2.7%. But keep in mind, when it comes to REITs, it's not really all that bad. And just recently, this REIT did mark a 2.7% higher dividend, up 56.5%, which is an increase from the previous 55-cent dividend. Now, another very important thing for long-term dividend investors is, of course, how safe the dividend actually is. And this right here shows that Simply Safe Dividends upgraded National Retail from a 70 to an 80, both being on the safe score, but 80 of course being higher on the safe score. In this article, they said National Retail Properties has continued to deliver steady performance coming out of the lockdowns. The retail REIT's occupancy exceeds 99%, rent collection remains near 100%, and cash flow per share has grown despite the rise in borrowing costs. So even currently in an environment where interest rates have been rising, National Retail has been able to hold it together and still generate cash flow, as well as receive all their rental payments on a consistent basis, which is very impressive. They then said with a healthy payout ratio of just below 70%, National Retail looks positioned to extend its 33-year dividend growth streak, with another low single-digit rise in July when management has historically evaluated the payout increases, which, as I just said earlier, they did raise it from 55 cents per share per quarter to around 56.5 cents. Further on, it says National Retail's cash flow is somewhat insulated from higher interest rates as well. The BBB Plus rated firm has a weighted average debt maturity in excess of 13 years, and over 95% of outstanding debt carries as fixed rates. So obviously that's very important in the commercial real estate space. In the real estate space, those that didn't fix their rates are definitely in a world of hurt, as interest rates have skyrocketed from 2-3% up to 7-8+%. But this right here says that National Retail has a long-term debt maturity of 13 years, and most of their debt carries a fixed rate, which shows that they're going to be just fine even if interest rates were to continue to go up from here. It also says this strong financial position has enabled National Retail to keep making opportunistic property acquisitions, while many companies with a weaker balance sheet have had to slow their activity in response to elevated capital market uncertainties. So keep in mind, during this time where debt has been more and more expensive to service, National Retail Properties with a strong balance sheet has been able to play on the offense and even acquire properties at distressed levels, which can make the company even stronger during the next cycle. It also says, recognizing National Retail's healthier payout ratio and solid balance sheet, we're upgrading the company from a 70 to an 80, with conservative underwriting, long lease durations, and a diversified portfolio of over 3,400 properties and 400 plus mostly e-commerce resistant tenants. National Retail should remain a slow but steady dividend grower that appeals especially for conservative income investors. So let's be real here. Is National Retail Properties going to be that one and only stock that's going to bring a small portfolio into the multi-millions overnight? Not even close. But is National Retail Properties a strong, solid company that's right now offering a very healthy starting dividend yield of well over 5% with a future runway of more and more dividend growth right in front of it? I would say absolutely. But when it comes to the REIT sector and National Retail, I want to hear from you guys down below. Is this currently a stock that you've been grabbing any shares of? Let us know down below why or why not. If you enjoyed this video, make sure to please drop a like on the video and subscribe for more. Thanks for stopping by, guys, and I'll see you in the next one.